Hello, everyone. My name is Frank Napolitani, and today we are talking alts with Kieran Cavanna of Old Farm Partners. In 2016, Kieran co-founded and is a CIO of Old Farm Partners, a hedge fund allocation firm focusing on small and mid-sized hedge funds, as well as co-investment opportunities with $270 million under management. Prior to Old Farm, Kieran worked at Soros Fund Management, where he served as the head of external manager selection team. And prior to Soros, Kieran was a partner and the head of research at Titan Advisors, a $4 billion fund of funds based in Stamford, Connecticut. Welcome, Kieran.
Hey, Frank, how are you?
Great, thank you. If you could, Kieran, can you spend 2 minutes and talk about Old Farm Partners?
Happy to. Thanks for the opportunity to talk. So we are my partner and I, Nishi Shah, we were at Soros together. We left Soros and we launched a strategy which is a mix of traditional hedge fund investing, so an absolute return strategy. So we're investing in hedge funds. It's about 80% of what we do are small and mid-sized managers. Guys are running like 300 million, 400 million, sort of our sweet spot. Mostly long short equity, and a little bit of macro, a little bit of event. But then we have about 20% of our book in co-investment strategies. And co-investment for us are liquid strategies, mostly equity, some credit. We have a couple of macro trades we've done. And we find it's a really good, elegant way to achieve absolute returns where you're getting very low fees because the co-investments are very low. We're not cutting our nose off to spite our face with low fees on the hedge fund side, where we're not going to invest in someone with 1.5 and 20. We actually will. And then, then you're not getting the adverse selection of the manager side. So I think there's a lot to do in the small manager space. And so far, so good.
Great. Well, thanks for joining me today. And before we jump into Q&A, I thought I would just summarize the current investment landscape. Yesterday, June 11th, we had a very wild ride with the S&P down 5.89%, NASDAQ down 5.27%. And before we jumped on this morning, it looks like they're rebounding a little bit, but obviously not quite as much. Year to date, the S&P 500 as of yesterday, including the drop, down 6%. Tech-heavy NASDAQ up 10.3, which I think is a big spread between those two indices. Peak to trough, we saw down 30.7, down 23.5 respectively for S&P and NAS. And then the rebound since then, again, including yesterday's performance, up 34.8, up 37.3 for the S&P 500 and NASDAQ respectively. Switching gears to hedge funds, the HFR weighted composite index as of the end of May was down 4.84%, year over year up 25 basis points. And one final stat, U.S. unemployment is currently 13.3%. Which includes 21 million Americans currently out of work, which is a drop of 2.5 million from the April report. So why don't we dive right in? So, the COVID-19 and shelter-in-place quarantine, how has that affected you performing investment due diligence?
It's harder to do, obviously. I think a lot of people are in the same boat. I'm out in Fairfield County, actually, where there are a lot of hedge fund people, whether investors or allocators. And actually, there's been decent interaction out here in the last month. But overall, I think people are finishing what's in their pipeline. I think it's very hard to meet a new manager and get a real strong sense for what they do, even with Zoom, even with, whatever way you can interact. I think it's harder to imagine investing with someone you hadn't met before. And that's going to change. If we don't get a second wave and we are going to get back on the road, that's going to be the motivating factor. I don't think longer term, though, we're going to just fly to San Francisco to see what's out there. I think you have to be really targeted. I mean, now the stakes are a little bit higher. But overall, we're getting a lot of work done. It's very seamless for everybody. I'm sure you've heard that, that operations have been good. I think people are much more comfortable with people working remotely now. So that's going to be one positive step, I think, for the industry.
Great. And listen, we've been on a roller coaster, even inclusive of yesterday, March, we talked about the peak to trough drops there. So how has this last 90, 120 days really affected the hedge fund market in general that you've seen? And without mentioning any names in your portfolio, how has this, affected your portfolio? And did managers do what they were supposed to do?
Yeah. Well, look, at the end of the day, I mean, there's a lot of news flow. It's incredible, right? And I won't go through it, but I'll tell you one thing that longer lasting is that the 10-year went from about 1.8 to 67 basis points.
Sure.
And I think for a lot of larger allocators and private wealth, and there's now everyone truly believes that fixed income is generally, it's not a place that you're going to generate any return. because you saw in March, people who stuck their neck out in credit and did more structured credit or high yield munis. I mean, they had some down, 20, 30% returns in those asset classes. And so now here you are. And I think one of the more lasting things is that fixed income is less attractive. And obviously, just from what you said, I mean, look at the volatility in the equity market. I mean, let's just hit refresh to see where we are. I mean, you'll have to do that every half hour. And obviously you can't invest that way. And I think hedge funds have become much more attractive. We're doing a lot better than that index that you mentioned. And I think a lot of hedge funds are doing a lot better. I think also March revealed itself to be very interesting. It's kind of like when the tide went out situation that Buffett often is quoted about, where you saw a lot of strategies that did not work, that were supposed to work. And then you saw a lot of things that did work. And frankly, long short equity hedge funds that are liquid and not levered, they generally did their job. We've had very wide dispersion of returns. And it's quite, there's a mix of luck, there's a mix of skill. I was just discussing a manager today, one of our core managers, who I think he's up more than 20 this year. And I think one of the things that really drove that was the fact that he understood that COVID was a much bigger deal 2 weeks before than the rest of us. And he started shorting travel names and started shorting anything consumer facing. And that, he had a 500 basis point short return in 2 weeks. And then he started deploying capital into things that got beaten down by the end of March. So, but then again, other managers I know, I have one who hit his pain threshold. He sort of down 20 at the bottom, and he said, no mas. And then he decided to, as he told me, COVID-proof his portfolio, which meant that everything that rebounded, third week of March on, he did not participate at all. And so now he's nursing sort of a down 12 or 13% year at this point. But overall, pretty interesting. I mean, incredible moments, right? And I think hedge funds look much more attractive. I don't think people want a ton more private equity than they already have. I spent a lot of time in credit. I don't have tons of it, but I actually feel credit, here we are with high yield close to its highs pre-March. And I think a lot of credit rebounded very quickly. So we deployed some capital into credit, but I don't find it as attractive right now. So we find a lot of long short guys are on their front foot, and I think they have a good opportunity ahead of them.
What would you say that March exposed? I don't know. What comes to mind to me is liquidity. Liquidity in a manager's book. What are some risks that March you feel exposed?
Well, I mean, I think that structured credit really impacted. They were very negatively impacted, and some of those funds, I mean, if they're in the press, who have suspended some redemptions or are unwinding, and after 2008, a tremor in 2015, and sort of giving you 5 to 7% type returns before March, and now they're down 25. I just feel like that, and as markets really seized up, as you know, I think it's going to be much tougher for people to deploy capital into thinking, I'm just going to get a little bit better returns than treasuries in that strategy. And that's one that I think, to your point on liquidity, right? It's dealer-driven market, and it dried up. I think quantitative strategies, more the stat arb area, I'm watching that carefully because there's so much money in that space. And, they did not do very well in March as a group. There are plenty that did, but the more market neutral levered guys didn't do very well. And that's going to be interesting to see how that plays out, nor they rebounded. I think, risk premia continues to be a massive disappointment. And there's a lot of money devoted to that. Those were supposed to be the alternative to hedge funds, cheaper, alternative. And that decidedly has not worked. So it's interesting. And then volatility arbitrage. I mean, I don't know how many of those funds blew up, but there were a lot. So it was really a revealing moment. Leverage became the enemy. Illiquidity, to your point, became the enemy. But then again, you can't read into it too much, because then the Fed stepped in and, investment grade. And then they said they were going to buy high yield ETFs, and that market firmed so fast. So, it's a really amazing moment, but I try not to learn too many lessons, because the news flow, it's so news flow dependent, meaning like, if we have a massive second wave here, the market's going to go, the equity market's going to go back down. The Fed's going to have to step in again. So, but what I love about long short is I've seen a lot of managers, they said they've traded more than they ever have. And I don't think that's a negative. I think that's positive in this market, that they've moved their net exposure around. So one of my favorite funds that we have money with is a healthcare fund in Boston. I think he came into the March 10% net long. By the end of March, he was 60 net long. And today he's like 25 net long. And he's up 9 or 10 this year. Really managed this well. And I think if the market gives you opportunities, this is what hedge funds do. And there's also another, bigger debate, I think, of whether or not, the active world is kind of taking the lead here from a beta world. I mean, obviously you could just have a 60-40 portfolio for many, many years. And maybe alpha's going to have its day after a decade of not doing so well.
Right. I personally don't want to jump up on a soapbox and talk about ETFs and how I think they have completely changed the overall market structure, but I agree on the active management side. Let's talk about and switch gears a little bit. How are you allocating to hedge funds? Take out the co-investment side for a second. Are you investing directly in the funds? Are these separately managed accounts? Can you speak to that?
Yeah, I mean, we're a small player, and so we're not doing, we can't command managed accounts of $50 million, but we've done a few managed accounts. We invest in the funds. We're not investing with a lot of younger day one guys who haven't managed money before. We're also cognizant that there are some 30-year-olds with some great ideas. So I'm looking for a variety of diversification. You can look at different continuums. And for me, it can be strategies from specialist hedge funds to generalists, but also I think about age. We have some guys in their 50s who've been through this a few times, and some guys who are in their mid 30s. And so we're investing, we're not very active. I mean, I think that we've generally been pleased with the managers. We've added one manager. I've actually decreased macro. We have global macro. I'm actually disappointed with macro and how they have done. There's some great managers in macro that I follow, but I mean, it's 50-50 whether or not you choose that right one. And I haven't cracked the code on how to find that, get on the best side of that 50%. So it feels like a random walk to me, but we're investing in LPs on the manager side.
Okay. And you brought up co-investment when you talked about the firm earlier before. Let's dive into that. So, I understand that you have a number of managers in your portfolio, and I would default to you if you want to mention how many those are or aren't. How many co-investment opportunities do you currently have? How do you get to, choosing a co-investment opportunity? Just speak about your process if you could.
Yeah, sure. I mean, I think it's a very exciting area. We're having a really good few months, including this month in June, May, April. We had a bad month in March, but generally we're having a pretty good year on co-invest, where our approach to co-investments is, I've seen a lot of people do it differently. Some of the bigger firms out there, people like Blackstone, have been real trailblazers in this area. And the way that we do it, my partner and I, we did this at our prior firm. What we're doing is looking for areas of expertise. So if a manager is a great biotech manager, and say we have a 5% allocation to that manager, we try to expose ourselves to their best ideas, whether it's a managed account or whether they set up an SPV themselves. I think it's a phenomenal way. I think managers underestimate how much it's a great tool for people like us, where, it's a great client retention tool because generally it's not that much more intellectual work for the manager, and you're offering low fees. And so that we like that a lot. And we have a number of managers that do things like that. And it's not just, healthcare and tech, which is, I think, strategy du jour, which we're heavy in as well. We've done things in the restaurant space. We did a casino REIT in the middle of that really went down a lot in March, and we added to it. And it's obviously those kind of things have rebounded. So it's a very interesting area. I think endowments, the ones I talk to, are really interested in that area. They're trying to figure out how to execute on that kind of strategy, because they've all done this in private equity. And it's much easier in private equity, I think, because they really rely on the manager. And that's our approach. We're relying on the manager. We're not trying to outthink and model a name. But what we're trying to do is do enough due diligence, and we understand what we're getting into, what the manager's history with names like this are, and if there's something special there. I'm seeing a lot of those come out in the last few months, by the way. I'm sure other people that you talk to will say the same thing.
And staying on, you mentioned tech and healthcare there for a second. Can you speak about tech and healthcare or any other sectors that either you find attractive or that you've gotten more negative about recently?
Yeah, I mean, I think macro is negative for me, but I think event-driven proved to be what I worried about, which was that it's, at times a euphemism for being crowded, especially when there's a fire, like in March. And although there's some great managers, there are, and event-driven could be really interesting. I'm really not sure yet, but because they're the types of guys who go into these energy ideas and these industrials that are beaten to hell. So hopefully more on the special sit side of event-driven might be more interesting than maybe merger arb. But tech and healthcare, obviously, they're up a lot. And some of those managers are doing really well. So people chase, and we all do. We all say we don't, but we all talk ourselves into it. But I do think that with tech and healthcare in the US, especially globally, technology and healthcare investing are really centered in the United States. And so money has flooded into the US into these spaces. I mean, Netflix and Google and, go down the list, those are very unique to the United States. And Europe doesn't have any of those. China does, but that's a closed market. And that's why Google's not in that market. So, but look at Alibaba. I mean, it's an incredible company. It's huge and it's growing. But what's interesting is that I think in tech, the managers that I follow, it's not about FANG, and everyone talks about FANG just driving the market and the narrowness of the market. But I've seen some incredible trading around names like Wayfair, which has been up and down, down 80%, up 400%, not 80, but something like that, 70, I think. But the market's giving you opportunities. And it's not just the U.S. I mean, I know managers many hedge funds are long SE is the ticker. That's Southeast Asia company that does a lot of search as well as other things, as well as things like Afterpay, which is in Australia. So anyway, it's very exciting. I see the same thing in healthcare and tech, though. Some guys, you're seeing very wide dispersion of returns. So we have actually 4 healthcare funds, which, my investors, some of them think it's too many. But, one of them runs between 0 and 30 net short, and he's up 9% this year. But then our guy who's running, 60 net long in biotech, he's like up 7 this year, and this is through the end of May. So it just shows you how much dispersion there are in these sectors. And I think that's what a lot of allocators look for are there long and short opportunities. I do think that the people who short for real, this is a very, really amazing moment and you're seeing that with like the Tiger world. Many of the Tiger seeds, the more newer ones that the next generation guys that have been done in the last 5 years, some of those guys have been exceptionally good where they're long growth and short value. And I think that people aren't tracking them as closely as they used to. When Julian Robertson would anoint the next guy, and that was incredible time, 10, 15 years ago. And I feel like actually that is coming back into vogue right here. And so I pay attention to that. And then a lot of the managers we actually like people who are outside New York City. I think that it's an interesting time to find managers in Dallas, Texas, and Charlottesville, Virginia. They're out there. They're smart as anybody else, and they're just seeing different inputs, rather than just the same inputs that a lot of people in New York are. So we have geographic mix, mostly U.S. Anyway, so that tech and healthcare remains probably the most exciting, but I'm always looking. I just looked at a co-investment in energy and decided not to do it. And so I think you have to have balance because we could have a value rip here, and you just can't get too pigeonholed into one thing.
Right. So you bring up a good point. You talked about managers outside of New York City. You mentioned some in Boston, Charlottesville, Dallas. How are you sourcing your managers traditionally, and then obviously how have you adapted to that now with the pandemic?
Well, I think in many ways, like for me, the pandemic's been fine for that because the startup scene has really slowed down, unfortunately, for those managers who wanted to start here. But I try to talk to as many managers as possible and not do calls because you can spend your day wasting your time on getting to know, first dates with a lot of managers. But what I love is reading manager letters because it gives me insight into how they think. It's prospective when they talk about ideas. I sometimes track those ideas. So best referrals are from existing managers who say, boy, this guy's really smart. I've done meetings with him for years. So that hasn't changed at all. We're much smaller than we were, at my prior firm, my prior two firms, had managers of 40 to 80 hedge funds. Today we have in our funds about 16 core managers and some co-investments that are different from those managers, but it's pretty concentrated. So I expect to have 2 managers a year, maybe 3 go in and out. That would be a lot. So anyway, sourcing's been great because everyone's sitting at home. You have access to anyone, right? I can't tell you how many guys I call, and I just call their cell phones who are managers, and they, the first ring they're picking up. Wasn't the case, maybe 3 months ago. And also, I think that our reading time has gone up a lot. I read a ton more.
So let's talk about you. Obviously, you focus on smaller and mid-sized managers. How early are you investing with managers? Is it day one? Is it year 2? Can you speak about that?
Well, it depends, right? I mean, I think you have to find your edge where it is. And for me, going to find a new manager, I don't know. Like I don't have the insight into a stranger just because I do a 2-hour interview with them that they're going to be the next best thing. But like what I find is that now I've been doing this now 15 years or so, you just get a lot of institutional knowledge. So we were day one with a hedge fund in London called Crake. It's hardly a day one. It was a guy named Martin Taylor who had managed an incredible hedge fund called Nevsky in 2000 and hung up his spurs at the end of, I think it was 16. And anyway, and he decided to come back, and that was a very large launch with oversubscribed launch. But I had a lot of insight because we had capital there before, and he knew what he was, knew he was an amazing guy. So he's hardly a startup, as an example, right? But I love finding people who are a little off the run that have a great record. Maybe they went to a public university, maybe University of Texas, but they had a full ride, or something like that. I've just encountered a manager in Dallas who went to Kansas State, and and I love that he basically got into the industry because he's one of the smartest people and aggressive, and not fell into it because he grew up on the Upper East Side. And why not? It sounds like a great idea to go into the hedge fund business. And by the way, your dad can give you $50 million. That's I've not had good luck with those types. But I do think that there's a ton of, information has been democratized. People are out there who are creative and disciplined and hardworking, and they don't have to be in New York City. So, I'm not answering your question directly, but I think that we want people who have managed money before in some capacity, whether they were at a platform or they were a sub fund that I can get arms around a record. I'm not big on people who are analysts somewhere who maybe they were the best analyst at a huge successful hedge fund, but it's very hard to figure that out, I think, until you actually see what they do on their own.
Right, and listen, I don't sit in your seat, but just thinking about being an analyst and knowing your names and portfolio construction are 2 very different things, and managing risk and grosses and nets. So can you speak about that?
No, I try not to overthink that. I try not to manage the book like it's my book. Like, I'm not a portfolio manager. I have instincts like everyone else, like you do. Like, boy, the market went down a lot yesterday, and boy, what would you be buying? But I don't act on that as much. I try to maintain balance. I try to be a good fiduciary for the people who gave me money. And I think that risk management first is the first thing. So I don't like to put together a portfolio of very risky people, hoping that, one's up 100, one's down 20, and, that meets out in the end. So we try to maintain a net exposure between 20 and somewhere between 20 and 50. We've really been below 40 the whole time. And we do that so I love finding non-correlated strategies like market neutral equity. We have a manager in San Francisco who's annualized about 11 with a negative correlation to the Russell and the S&P. That's like genius for a portfolio construction, right? Where I can put that in there, and then I can take a little more risk on the long side. And so we have a financials fund that's always been above 50 net, who's done pretty well, actually. So, I try to think about that as portfolio construction is sort of weaved into how we look at managers bottom up. I try to understand what they do, and what is it, how would it fit, or how would it be different than what we have already? And so there's a lot to do.
Understood, and thank you. And one final topic here. Why don't I turn this back to you? And any final thoughts that you have that come to mind that we haven't touched on today?
Not sure. I think it's pretty interesting what's happening, and it's very dynamic. And I think if you want one quick thought, it's that for 10 years, sort of the decade that ended in 19, hedge funds didn't do that great relative to the S&P, which annualized about 14 and a half. But the prior decade, the S&P 2000 to 2009, the S&P annualized at zero. Same with the MSI World. And hedge funds did really well. And I'm thinking that more and more, now that you have rates where they are and you have the S&P where it is the hard part is on the go forward basis of earnings, because we really don't know. It's really incredible how many companies have pulled guidance. So, but valuations are high. Money is flooded into the equity market. And so actually I think you can have a really good decade of hedge funds doing really well relative to the market. And for the first time, you're really not going to get anything from fixed income, which I can't stress enough. I talked to my European clients about this, and they've been dealing with zero rates for a long time, and it's causing them to have to do things a little bit differently than they had forever, in their careers. So it could be great for hedge funds. I hope for both of us, obviously, that's a good thing. So.
Well, great. I want to thank you for joining me today. I really enjoyed speaking with you. Hopefully everybody else enjoys our conversation as much as I did. And I wish you a great summer.
And you too, Frank. I'll see you soon, I hope. Okay.
Thank you, Kieran. Take care.
Take care. Bye.